Uh, okay, the recording just began, so I'll start over. For Mayor Adams.
Kevin New.
Okay, for Controller Lander.
Allison Hirsch for Controller Lambert.
Allison Hirsch. And also John Dorsa for Controller Lander. For the UFA, Mr. Andrew Ansbro.
Eustace with Andrew Prosky.
Mr. Eustace, present. Okay. Mr. Edward Brown.
Yeah.
Okay, Mr. Eric Bischoff.
Virtually present.
For Finance Commissioner Nybach.
Phil Dukes.
Okay, and for UFA, Mr. Peter DeVita, I'm sorry.
On Young
Don,
one, Peter
got
DeVitas. Proxy.
All righty, and for the UFOA, Mr. Christopher Jensen.
Here.
Mr. Liam Guilfoyle.
Here.
Mr. Jim Brosey,
Yeah.
and for the Fire Commissioner,
Carol Brown for Commissioner Cap.
Terrell Brown for Commissioner Kavanaugh, we have a quorum.
Thank you. And so for the first item on the agenda is a market overview, quarterly performance overview.
Yeah, that's fine. Yes, I do.
Good morning, trustees. And thanks for having me today. Let me give you a quick market update, really kind of a brief overview of what's going on in the economy and what's going on in financial and investment markets, and more importantly, what's gone on in your portfolio for the third quarter of this year. Kate, are you there with the slides? There we go. Great. On the first slide, obviously inflation has been on the front of everyone's mind these days, particularly at the Fed, the White House, and anyone that's actually been spending any money in the economy. Inflation actually hit a 40-year high in the third quarter, but the fourth quarter reports recently have been much more encouraging. We continue to see significant U.S. employment, very strong, putting wage price pressures on services in particular. There's some residual supply chain bottlenecks associated with the COVID and China lockdown, although that's abating as well. It's increased input costs. And lastly, oil and energy prices are still relatively high following Russia's invasion of Ukraine. Fed Chair Powell recently reflected that inflation has spread broadly throughout the economy. And again, they're taking steps, which I'll talk about in a moment, to combat that. On the next slide, a quick look at CPI. It's well off its 40-year high of 9.1% experienced in the third quarter. It's now 7.1% now. You can't see it, it's on the far right-hand side of the chart, but take my word for it. The inflation has come down 2 percentage points since the summer. Core PCE has been a little more sticky. That tends to be one of the Fed's favorite indices, the personal consumption expenditure deflator. It's lower in November at 5%, but still relatively high and expected to come down hopefully in the coming months. On the next slide, similar to this slide, here we get a better view here. You can see that inflation's been really kind of a worldwide problem. In the red, you can see the U.S. inflation rate again coming down, as I mentioned, 2 points, 200 basis points. It's still relatively high in the Eurozone at 10%, although off the boil, coming down from 10.6%, and still very high and elevated in the UK at over 11%. And the next slide is expected inflation looked at as the University of Michigan survey results shows that the expectations are trending lower and expectations for inflation over the next 12 months among participants is actually just 4.9%. So moving in the right direction. On the next slide, a look at U.S. employment. U.S. employment, as I suggested earlier, continues to be very strong. Unemployment actually hit a 50-year low of 3.5% in the third quarter. October, November, it's gone up to 3.7%, but still very, very strong. And actually, both of those months came in above expectations. On the next slide, we still see a persistent post-COVID imbalance in the labor market. Right now, we've got about 4 million additional open positions, and there are candidates to fill them. Some of that has to do with people retiring early. That yellow line actually reflects the labor force participation rate, which is still over 1% below where it was pre-COVID, and that's part of the problem. I think there perhaps are also some long-term structural imbalances in the labor force. associated with demographics as baby boomers retire. We've had low birth rates for a couple of decades now, and we've had stifled immigration, which is creating, again, that imbalance. The Fed actually hopes to balance the labor market by slowing job growth, by slowing the economy and increasing unemployment rate. On the next slide, third quarter GDP growth came in at 2.9%. It was revised up from 2.6%. And actually, it was revised upward again this morning to 3.2% for the third quarter. That follows 2 quarters of negative GDP growth in the first and second quarter of calendar year 2022. The economy still looks strong, particularly given the Fed's position in terms of monetary tightening and raising short rates. The fourth quarter looks to be pretty constructive right now at anywhere between 2.5% and 3.5% GDP growth. So that slowdown that the Fed is trying to engineer seems to be still off a little bit. And finally, global economic growth is still sluggish overall at around 2.2% expected in 2023. On the next slide, just a quick look at where we were over the last 10 years. That red line that hovers above all the other lines is the Chinese GDP growth, which typically was an engine for global growth coming in at between 7 and 8%. As with the rest of the world, the growth rate in China dipped down at the pandemic, recovered afterwards, but given their COVID protocols, which have just recently been relaxed, the growth there has been very sluggish and really hasn't been, again, that engine of growth that the world had gotten accustomed to. On the next slide, housing is a significant negative factor impacting U.S. growth. On the lower left-hand side of the slide, you can see that red line trending down. That's existing single-family home sales. It's down over 20% since the Fed's first rate hike in March. And the number out this morning reflected that existing home sales is down fully 34% year over year this month. On the next slide, overall housing inflation is poised to move lower. You can see the new lease inflation rate turning down. That just basically means that those individuals that have a lease, when they renegotiate it in the coming months, it'll be increased by a decreasing percentage point. So again, some positive moves there. And owner's equivalent rent measured, which is in blue, appears to be peaking. At least the hope and expectation is that that's the case. On the next slide, U.S. consumers continue to be incredibly resilient, and consumer confidence is actually very high. It's high for a couple of reasons. It's the highest this month has been since April. As inflation's come down, it's empowered consumers. Also, there's a very strong job market. So if you lose your job, there's another one that's pretty easy to find. The surplus savings rate, which really this reflects, is that occurred during COVID, peaked at about $2.6 trillion in extra or surplus savings, which is certainly supporting spending in 2022. But that dry powder has been depleted this year, which takes me to the next slide. You can see a run up in primarily credit card debt associated with that spending. This is not a positive development, and it particularly has a negative impact on the lower half of those wage and income earners in the United States. On the next slide, the Fed's response to this high inflation that I spoke about earlier has been incredibly aggressive and noteworthy from a historical perspective. We've had 7 rate increases in 2022, starting with 25 basis points in March, followed by a 50, then 4 75 basis point rate hikes, and another one this month of just 50. That's taken the rate, the lower rate from 0 to 4.25. So obviously a very, very aggressive Fed to address those needs. The ECB, the Bank of England, have also been aggressively raising rates, pretty much the same pace, but not the same magnitude as the Fed. Even the Bank of Japan surprised the market this week by relaxing its yield curve control and letting its 10-year JDBs, or Japanese government bonds, yield move up from 25 basis point cap to as much as 50 basis points. And it's gotten there almost in 2 days. On the next slide, just the top of this slide, again, it's blocked down on the screen. On the far right-hand side, it just shows you the magnitude of the rate hikes that we've seen this year. Next page, next slide rather. You get a sense for how fast and furious the Fed's hiking cycle has been. Remember the last hiking cycle in 2016 to 18? The Fed hiked 25 basis points and then was on hold for a full year. Obviously, that hasn't been the case this year. They've been very, very aggressive. And at some point, these rate hikes will have an impact in slowing the economy. On the next slide.
Sorry, can we minimize the Zoom window so that everyone can see all of the slides?
There we go.
There we go.
Thank you very much.
Yeah.
On this slide, the significance of this year's bond market declines cannot be overstated. The 10-year yield started the year at about 1.5%. It went as high as 4.25% on 10s in November. They're about 365 today, or 3.65%. And we have what's referred to as an inverted yield curve, with the 2-year yields about 55 basis points above the 10-year yields. That's an unusual circumstance. It's rare, and what it indicates is that the market expects the Fed to be successful in slowing the economy, ultimately pushing the economy into a recession or dramatic slowdown, and then reducing short rates to bring them back in that normal situation with longer rates being higher. On the next slide, a quick look at the yield curves. You can see that the rates have moved up and the curve shifted upward this year. The red at the top is the most recent look at the yield curve, and you can see that bump in the short end, reflective of the Fed's continued hiking cycle. On the right-hand side, you can see this, the inversion, which is as wide as 81 basis points earlier this year. It's now inverted just 55 basis points. And to give some historical perspective, back in 1981, that yield curve was inverted by 250 basis points. On the next slide, a quick look at high yield spreads. They've moved higher and have been somewhat volatile. They started the year about 300 basis points over treasuries, were as wide as 600, came down to 450, went out again to 600. Now they're about 450 today. Interesting, but not compelling, given the fact that we may see a recession in 2023. On the next slide, US dollar strength has been a persistent theme for most of the year. This has been very challenging for US corporations, particularly large cap companies that have sales and revenues from abroad. And as they repatriate those and reestablish those in dollars, they come back at a lower level. It's also, the good news is we've seen the dollar weaken recently, particularly against the yen. I mentioned the Japanese, the JGB, or the Bank of Japan rather, had relaxed its yield curve control or qualitative easing. And the yen actually appreciated relative to the dollar significantly, about 12%. On the next slide, just to look at that, where we are against the three big currencies, the euro, the pound sterling, and the Japanese yen. You can see it's come off the boil on the far right-hand side. And we expect the dollar to continue to move lower as other central banks catch up to our hiking cycle around the world. On the next slide, actually, this is probably one of my favorite slides. And look at the upper left-hand side, and I'll read it to you. It actually says, this has been one of the most devastating times for bonds since at least 1926, and maybe in centuries. And then it goes on to say that much of the damage is probably behind us, which is the good news. We've had a lot of volatility in both the bond and equity markets this year. It's been very unusual. We've gone through over a 30-year secular decline in interest rates. And if you look at our portfolio, typically you'd expect for fixed income to provide some level of ballast and offset against equity declines. We haven't seen that this year. And the good news is that that's largely behind us, and that bonds at this point are more attractive as an offset to equities in a portfolio. On the next slide, I talked about the fact that you couldn't understate the impact of rising yields this year. This is actually a look at the sovereign bond market. On the far right-hand side, you can see the magnitude of increases in yields that we've experienced this year. So over 200 basis points or 2 percentage points is on the far right-hand side when you look at the US Treasury 10 years. There's two countries worth noting here. Japan, at increasing just 18 basis points, that's now 33 basis points, given the yield curve control relaxation we saw earlier this week. And China, at the very bottom on the far right-hand side, you can see their yields have actually contracted a bit. And that's because the Chinese central bank was reducing rates in August because of the economic conditions there. On the next slide, just to look at volatility. It's been fairly volatile. Volatility on the left-hand side is measured by the VIX. That's come off quite a bit. It's at 20 now. The 30-year average is 19, but it still is persistently high in fixed income on the right. On the next slide, just a look at market returns. On the left-hand side, you can see in blue, we've had the Russell 3000 decline, still 19% year to date. Developed market international ex-US down about 23-24%, reflected in gray. And last is the emerging market equities down over 30% in red. So it's been a very challenging year. On the right-hand side is a look at the Bloomberg Aggregate Index, which is a bond measure. And that's off, at this point, it was off 16%. It's actually recovered a little bit, but it's still down 12% year to date. On the following slide, I'll look at that traditional 60-40 portfolio that's been quoted 60% equity and 40% fixed income. Even that hasn't really provided much of an offset. It's down fully 16% year to date in 2022. Couple final notes just on the conditions that we're dealing with now in the marketplace. On the upper left-hand side, listen, I reflect that crypto, in particular FTX, has had a pretty dramatic collapse. We have no exposure to crypto. We don't invest in crypto on your behalf, and you haven't authorized us to do so. But it's noteworthy because there hasn't, with the Fed's rate hiking cycle, typically something breaks, historically something breaks. And the only really cracks that we've seen are in the crypto sector in particular. We've had some other things in the marketplace slightly below that is a look at the fact that we've had 3 prime ministers in the UK in 3 months. We also had a fairly significant October bond market disruption and sell-off with Liz Truss's ill-fated fiscal plan that resulted in her being removed from power. On the right-hand side, you've had a little bit of stress in Credit Suisse, more on the business side, and a capital raise required to shore up that very large international bank. The war in Ukraine is ongoing and continues to have a negative impact on global growth. And finally, on the far right-hand side, Chinese unrest has actually given rise to a dramatic relaxation of COVID protocols in that country, a rise in COVID, but the expectation is that that will be positive for the economy, perhaps global growth in 2023 and beyond. On the next slide, there is no predictive value in this slide, and I don't know why I put it on here. I just find it really interesting. If you look at the period between 2006 and 2009 reflected in blue, it actually looks pretty close to what we've experienced in terms of the VIX or the volatility index in stocks year to date. Perhaps more interesting is the next page, where we look at the same pattern for the S&P 500. It seems to mirror that pattern that we've seen this year in terms of the decline in valuations there as well. Again, that looks like it stops, the blue line stops right before the Lehman Brothers default in September 2008. Again, no predictive value here, but we have been through a process where we've seen an interest rate shock impacting yields and spilling over to the equities. At some point, we'll see that show up in earnings in terms of earnings declines. And what we hope doesn't happen is a liquidity shock impacting the market to drive things lower. Now to get to more of the meat of the discussion, to look at your performance in the third quarter of this year. The public market returns are reflected here. Obviously, in the middle, it's been a very tough third quarter for investors, both equity and fixed income. It's been even a tougher year for investors in equity and fixed income. There really hasn't been any place to hide in the public markets in 2022. And the next slide is a look at the public market returns by strategy, and these are for your portfolio. These are net returns. So your performance has been roughly in line with public market assets and benchmarks. You can see that in the 3 months they've declined pretty consistently, and certainly for the year, some pretty dramatic declines in the equity and the fixed income market on a relative basis. The good news is the returns in the longer term, in the 5-year sector, are still generally quite positive. On the next slide, perhaps a little better news. I said there's no place to hide in the public market sector. In the private markets, the performance has been pretty dramatically different and positive. And you can see that your performance and hedge funds have been a pretty good offset for the volatility we've seen and the negative returns in equities and fixed income, coming in just down 1.2% for the year. Private equity continues to be very constructive and strong at over 9% for the year. Core real estate up 32%, non-core up 23%, infrastructure 14%, and opportunistic fixed income through September up 1%. So some pretty good returns there. The lower part of the screen actually reflects your performance. On the top line, Fire's total plan came in at a negative 3.9% for the quarter. That's about 140 basis points of outperformance relative to your policy benchmark below that at -5.3%. And actually in all periods, your plan and your portfolio has outperformed your policy benchmark, which is very positive. And on the next slide, a quick look at the attribution. So it's primarily from investment manager selection on the far right-hand side, delivering 140 basis points of outperformance. So certainly a positive development. On the next slide, just a quick look at the excess return by asset class relative to benchmark. And you can see that it's been a pretty good third quarter relative to the benchmarks. The only underperformance has come in large cap or US stocks. The Russell 3000, we've underperformed by 14 basis points. But by and large, across equities and fixed income, the performance has been positive relative to those benchmarks. On the next slide, a look at your outperformance relative to the private markets and alternative markets and hedge funds. There, it's been a very positive story where the excess performance has been significant, again, relative to those public market equivalent benchmarks in the center there. The only negative we have is in non-core real estate, and that has more to do with the fact that you've been a pretty significant and consistent investor since the 2018 period in this sector. And you're really stuck in the J curve where most of the, you've had mostly capital commitments with very few distributions. There's also some holdings in retail and hotels that continue to be hurt by the coming out of the pandemic. Excuse me. And lastly, look at the rebalancing activity for a portfolio. I know we've got John Mercerberg, who's the authority on everything equity in the room. But basically, it was really just restructuring. And I think, John, that was to reallocate to the mid cap.
That was part of it.
Sorry, I can't really hear Don.
He was just reflecting that we've funded some of the mid cap managers mid-year, mid-quarter rather.
We're just doing some rebalancing to be more neutral to the Russell 3000 benchmark.
Great, thanks, John. Sorry to put you on the spot. And there's also, we sold some intermediate fixed income to raise cash for capital calls and distributions as well. And the last slide that I have for now, for the third quarter, you can see the ending period on the far right-hand side. We've been very careful and very consistently managing to your targets, and everything is well within tolerance and well within the ranges associated with the asset allocation targets. And with that, I'll open up to questions.
So if there are no questions, we have a risk presentation that functions in conjunction with the report that you just saw. So we'll ask Ed Berman to come up. Just to remind folks, if you have questions at any point during this meeting or even after the meeting, feel free to reach out to the control's office. You can reach out to Allison and I, or reach out to Steve directly, and we'll try to get you any answers to any questions about the portfolio that we can. So Ed, it's all yours.
Thank you, John. And I'd like to second John's point. If there are any questions after this presentation, otherwise we'll be more than happy to get engaged in the dialogue and just answer any questions, whatever you may have. So with this in mind, let's just jump straight into it. Will our risk presentation follow the same outline as the previous time? So it'll be 3 sections. On page 1, we'll review the exposures for the entire system, the top level risk levels. In section 2, we'll dive inside the portfolio and look at the details of the performance and risk concentration for individual asset classes. And finally, 3rd section, we'll focus on our forward-looking assumptions, and that's where we'll show you some new analysis that came of our risk framework at that. So with this in mind, look at the first page on the screen. So the total risk level for the portfolio at the end of 3rd quarter stood at 11.9%, up about 30 basis points from the previous quarter. You can see this number at the bottom right in the table on the screen. So 2 questions come to mind. First of all, is it a reasonable number, 11.9? What does it mean? Should we worry about it? And the second question, is the change in the right direction. Why did the risk level change? So we'll try to answer these questions both from the portfolio construction point of view and in the context of a market dynamics. So with this in mind, let's just think, talking about the portfolio construction, it goes into 3 steps. First of all, the most important question is determine the stock bond split, how much we allocate to stock, how much to equity. So this is captured in a so-called market portfolio, which is simply a 65-35 blend of the MSCI World and the Barclays Act. So broad measures of markets, and it's captured in column 1. The second step of the asset allocation process, the second step of the investment process is the asset allocation, where the equity and the bond allocation is further split into individual buckets. And that's captured by the strategic benchmark. You can see the column 2. That's 13 components you can also see at the bottom of the page. I'm not going to read them. And finally, the last step of the investment process is actual portfolio construction, where we select managers, and that also includes any technicals throughout the quarter, the need for cash, the rebalancing, and private equity flows. And that's captured in the column 3, which is the actual portfolio. So let's take it in steps, starting with the market portfolio in column 1, the 65-35. So there are 3 main dimensions of risk, which correspond to the 3 main opportunities to generate the returns. The first is the equity risk, and that's of course measured by our equity allocation. It's 65% by construction, it's our choice. The second dimension is the interest rates, and that's of course the cost of capital. We usually measure the interest rate exposure through duration. You can see duration is 2.2 years. What does this number mean? I think of it as just simple multiplier that translates the interest rate moves into market value moves. So duration of 2.2 years simply means that for 1% increase in rates, the portfolio will gain 2.2%. You'll notice that the duration is down slightly for the quarter, and that's simply because of the impact of interest rates and the rising interest rate environment. Durations tend to short. And finally, the third dimension of risk is what we call credit spread, and it's a measure of a default risk, or the risk that money lent may not be repaid back to the lender. And that's again, we measure using the duration, credit spread duration. You can see it's 1.3 years, and it's exactly the same concept. It means that for a 1% widening of the spreads, the portfolio loses 1.3%. You'll notice that spread duration is lower than interest rate duration. It's simply because in the Barclays Act, about 60% of the portfolio actually government securities that carry no credit risk. So what does it mean for risks? You can see at the bottom of the table. You see that the total risk of this market portfolio is 12.5%. Again, just to remind you, this number actually means the expected performance of the portfolio. So the risk of 12.5% means that over the next 12 months, we expect the performance of the portfolio to be within 12.5% range. And of course, there's a 15% probability that performance will be better, and a 15% probability that performance will be much worse. The second measure of risk, and I'm sorry, important to mention, you can see that this total risk level went up by 0.5%. And why is that? And it's simply the reflection of turbulent markets that we faced in Q3, and Steve covered it in details just a few minutes ago. The key measures of risk, like the VIX index, which is the measure of equity volatility, closed the quarter at about 30 points. And that compares to about the 18-point average in the pre-COVID. So it's a significant increase. And on the fixed income side, it was even more severe. The MOVE index, which is a measure of fixed income volatility, closed at 160 for the quarter versus about 60 points, the pre-COVID average. So it's important to keep these 2 numbers in mind, because that's the basis point for further analysis, 12.5%, 0.5% increase.
Can I ask, can you remind the board what the Barra model is using for the risk measures for each asset class that roll up to these numbers? Is it a trailing 3-year number for volatility?
No, it's actually for not to get too technical. The bar model is using 20 years of history with a 3-year half-life for the assets and 2-year half-life for correlations.
So when these numbers move, it's a reflection of what's happened more in the more recent past. Is that
Because of
fair
the time
statement?
decay, it's weighted
Okay.
towards the recent history, yes.
All right, thanks.
But the model evolves slowly because of a long half-life, so that's why you see only a 50 basis point pickup in risk as opposed to what you see in the markets. We find this calibration to be more appropriate for this portfolio, given the long-term orientation of the investment process. Like for give an idea, if it's a hedge fund with a very short-term investment outlook, you'll probably use a much shorter calibration. For long-term portfolio, we use a longer calibration. And just to get back to the risks, again, market portfolio, we cover the total risk. The second measure of risk we use at the bottom of the page is the beta to the S&P 500. So now this is a more responsive measure. Remember that we define total risk as a 12 months expectation. So the beta will be a more shorter term measure. And what it means, the beta of 0.61 means that for 1% increase in the S&P, the entire portfolio will gain 61 basis points. Now notice this number is actually lower than the equity allocation. The equity allocation is 65%. And it's simply because, first of all, we have a fair amount of international exposure, which is not S&P, and also because of the diversification between equity and fixed income, the risk levels come down. So that's actually something we want to see. It's a positive outcome. So let's move towards our strategic, which includes the asset allocation decisions and captured in column 2 policy benchmark. Starting with portfolio construction, so the equity allocation is exactly the same, 65%. You'll notice that interest rate duration is slightly shorter, and the credit spread also slightly on the shorter side. Again, not dramatic moves. What it means for risks, you'll notice that the total risk level is actually coming down slightly. It's 11.6% versus 12.5%. And why is that? This is the diversification effect of our asset allocation. Yeah, that's exactly why we allocate to so many buckets in the portfolio. It's a desirable outcome. And again, it's a positive. It's also noticed that the increase in the risk level plus 0.3% is broadly in line with the market portfolio. So it tells us that the increase in risk is driven by markets, not by the benchmark. And finally, the beta to S&P, again, 0.58, slightly lower than for the market portfolio, consistent with everything we just discussed. Nothing to worry about. It's all good. Now, with this in mind, we can move on to your portfolio. It's in column 3. And again, you can see that the portfolio is very closely aligned with the strategic benchmark, which is, hope not a surprise to anyone. You see a very small change in the equity level, 0.5%. It's really within daily fluctuation. It's well within rebalancing ranges. You'll notice that the duration may be slightly higher, which is not surprising given that there's a material allocation to the ETI strategy, which brings longer duration. So that's clear. And the spread duration is slightly lower. And this is mostly because of what our managers, the tilts taken by the managers inside their portfolios. So what does it mean for risk? Again, you'll notice that the risk level is very similar to the strategic benchmark. We're talking about 11.9 versus 11.6. There's a small pickup in risk, and we'll see more about it on the next page, but the answer is it's all about private equity. That's the majority of the risk increase. And you can see that the beta to the S&P 0.58 is exactly the same as for the benchmark. Again, everything is in line as we expect it to be. We know that your portfolio is matched very close to the benchmark. So again, it's a good message. And here we introduce the third measure of risk, which I would argue is maybe more important, active risk. So we talked about the total risk measure, and we defined it in terms of the absolute performance of the portfolio, the expected 12 months return. Similar, active risk simply means the expected excess return over the benchmark over the next 12 months. with the usual caveat, 15% more, 50% less. So 2.1%, and again, we'll talk about a little bit more on the next page. But just to give you a punchline, about 3/4 of it is driven by the leverage buyout strategies in the private equity. And lastly, before I move to the next page, I want to draw your attention to the two charts on the right-hand side. That's where we capture the dynamics and the recent evolution of these three portfolios. And you can see that this relationship we just talked about between these three portfolios held broadly constant throughout the past 12 months, right? So it's not a fluke, it's part of the design, and it gives me comfort that your portfolio is performing according to the expectations. And again, at the bottom of the page, you see active risk. Again, it's moving in the same range. You see that both charts bottomed out around December last year. It's picking up from there. And again, this is mostly, not mostly, almost exclusively driven by the market volatility. I'll pause here for a second if any questions. So okay, the next page, please. Okay, so here we take a look inside the portfolio, just dive into the numbers. I know it's a lot of numbers on the page, but let's just focus column by column. First of all, column 1, they're labeled at the top of the page, the allocations. You can see that your portfolio is managed very close to the benchmark. Again, no big surprises. Just to mind, we show here without marketplace adjustments, so it's actual exposures against the actual benchmark. And you'll see that the allocation within public markets track very closely the benchmark. You'll also notice there's some deviations in the alternatives, and I hope it's not a surprise for anyone. We discussed it before. I hope it's well publicized. On the private equity side, we have a slight overweight, and we have a small underweight in the infrastructure allocation. Yeah, I hope no surprises. Next, we're looking at the total risk level for individual asset classes. That's column 2. And also the same information is captured in the chart on the bottom of the page, maybe a little bit easier to follow the graphical representation. And here we show in the blue bars represent the allocation, and the orange bars represent the risk contribution to the portfolio. So a few observations, very similar to what we said last time. So you'll notice the two asset classes punch well above their weight in the portfolio, and that's US equity and private equity. And again, this is just the nature of the asset class. It's consistent with the asset allocation process. The fixed income, core fixed income tips create useful balance to the portfolio. You can see despite the material allocation, the risk contribution of these strategies is almost negligible, and high yield sits somewhere in between. So no surprises, it's all as expected to be. Next, we'll look at the active risk in column 3. And to me, it's one of the most important measures of risk. Given that the majority of the portfolio is measured close to the benchmark, aside from alternatives, that's where you can assess the success of this investment process. So first thing to note is that for the public assets, active risk is low, very low. So you can see that for equities, it stands at 0.8. For fixed income, it's 30 basis points. That's exactly what we want. It's how we expect it to be. There are some pockets of risk in equities. Developed market ex-US strategy has a fairly large active risk allocation, 2.7%. And that's because some of the active managers, I was told, cannot mention any names in the public session, so we can discuss it offline. But some of the managers take active risk levels of 17, 20%, which are very high numbers, and it shows at the strategy level. And the same thing in emerging markets, you see a fairly significant level of active risk. That's a reflection of active nature of the managers. Fixed income, close to zero. Alternatives, that's where you see big numbers. And intuitively, it makes sense. So we know that private equity, which is nominally benchmark of the Russell 3000, behaves nothing like the Russell, right? We see that the performance, and Steve covered in a lot of details, as public markets go down, your private investments deliver positive results. So that's why you see this active risk such a high level. But what's interesting to notice here is how the risk level connects to the performance. Because remember, we mentioned that several times that risk is ultimately it's a measure of expected performance. So how does our risk estimate connect to the performance? You can see the performance, the trailing 12 months returns at the asset class level in the column 4. So first of all, on the public side, it's a sea of red. Every single note is red. And again, I refer back to Steve's presentation because that's what it is. It's a very challenging time in the markets. You see black color and alternatives. And that's why we see the diversification in action, and we see the helpful contribution of private assets. But let's focus on the returns versus the risk projections. For public markets, I would say active risk is by far more important, given that public markets are managed close to the benchmark. And you can notice that for some of the notes under public equities, the losses exceeded our risk forecast by a wide margin, specifically developed market ex-US. And again, some of the managers, I'm not naming anyone, look at John, delivered the fairly significant losses for this year. So it's not surprising that our statistical measures are not capturing this fairly unique market. So it's not really a cause for concern, but it's something that we obviously track and keep in mind. On the fixed income side, the absolute returns, again, the losses exceeded our risk forecast, but most importantly, the excess returns were mostly in line with projections. So that's again a good outcome. And on the alternative side, they're big numbers, they're good numbers. I would like just to point out real estate, where the returns significantly exceeded the risk forecast in a positive way. Doesn't happen very often. We hope this performance will continue, but history tends to mean the verdict. I'll pause here for a second if there are any questions about the portfolio before we move to the next page. All right. Can we have the next page, please? Thank you. So here we present our forward-looking. Here we present our forward-looking projections, and you'll notice this page looks quite different from the previous time. Because we thought we'd bring you some new risk analysis that came out of our new risk framework. So we do not know what the future will be, but we can identify which market factors will influence your portfolio the most. So to do this, we split the world into 3 broad buckets: the equity market, the rates, and the commodities. Starting with equities, you can see it at the top left corner of the table. The 3 main markets for equities are the United States, the emerging markets, really China, and Europe. So taken together, these 3 centers make up almost 3/4, slightly less, of the global equity market. The US alone is more than 40% of global market capitalization. In the rates bucket, we have the 2-year treasury, which is really a proxy for the federal fund policy rate. So the 2-year is a better proxy because it captures the policy rate and also the market expectations for the future evolution of the market rate. The 10-year treasury is a benchmark used for mortgages, for corporate lending, and one of the widely tracked benchmarks globally for the real world economy. And finally, the dollar. Obviously, the dollar has been in the news. There was a fairly dramatic run-up in the dollar rates. We captured here by the euro-dollar exchange rate, which is one of the main contributors to the dollar index. And finally, in the commodities bucket, and commodities here capture the real economy. So we have copper, and copper is really a proxy for the global GDP. So copper correlates with the economical development everywhere. Almost anything being manufactured has some copper inputs. Oil is clearly the blood of the economy. It's everything, transportation, manufacturing, everything. And finally, inflation obviously needs no introduction. It's something that we've been living with for the past 2 years. So the next step in our process, we trying to identify the worst market with the worst expected market moves. Now, we do not know what the future will be, so we cannot really forecast it. What we can do, we can identify the worst move in the context of the existing markets. And in this particular case, we estimate to the 8% probability, which roughly corresponds to the worst monthly move in the next 12 months. You can see these numbers under the market move column. And I want to pause for a second just to appreciate the magnitude of these numbers. These are really truly huge numbers. Look on the equities. So the model forecasts that there is a material probability for almost a 30% monthly move for the next year. It's a huge number. So we don't know if markets will move up or down, if it's melt up or melt down, but a 30% move for equities tells you everything you need to know about how crazy the markets are. Similarly, in the rates bucket, a 2-year treasury moving by 160 basis points is unprecedented. The dollar exchange rate, euro dollar exchange rate, a 10% move, again, just a couple of years ago, people would say it's impossible. Equally in the commodities, for example, for oil, the model forecasts the 57% change. So put in the context, if oil price now is about $77, a 57% move will take it from about 35 to 120. It's a very wide range, but again, intuitively kind of makes sense given that oil prices went from big negative to almost $120 recently. So what does it mean for your portfolio? So you can see the results in the next 2 columns, risk on and risk off. So here we define risk on as a scenario when asset prices rally and risk off when prices decline. So we show here 18 scenarios for the portfolio and 18 scenarios for the policy benchmark, so 36 stress tests altogether. I'm not going to read the numbers here, so I'll just give you the summary. So first of all, in the equity buckets, the most important conclusion here is that your portfolio is sensitive mostly to the S&P 500. There's less sensitivity to Europe and less sensitivity to China or emerging markets. Now you can say that we know this from just from the portfolio construction. The majority of our equity allocation is in the United States, but allocation is not the same as exposure. Just think about the recent COVID lockdowns in China having material impact on the Apple's earnings. So exposure is actually more complicated. But looking at these numbers, I'm getting some comfort knowing that your portfolio is driven mostly by the US equities, not by China, not by Europe. And even though all economies globally have some problems, I would say having the domestic exposure is probably better. Again, it's a good message. In the rates bucket. So that's probably the most interesting conclusion of them all. Look at the line 4, the 2-year treasury. So for 160 basis point move in the 2-year treasury, which is almost unprecedented, your portfolio gains only 80 basis points. So despite all this noise about the federal fund policy rate, your portfolio is not that sensitive to the policy rate. What is sensitive to? Line 6, the dollar exchange rate. So in this case, the weakening of the dollar will be positive for your portfolio. And that's by far something you need to watch to understand the performance. And lastly, on the commodity side. So that's where you see some bigger numbers. Copper. So a 35% rally in copper prices will mean a 6.6% gain for the portfolio. And again, just to remind you, copper, we use copper as a proxy for the GDP. But the most important, of course, oil is high in importance, but the most important of them all is inflation, which I hope not a surprise. It's in line 9. And you can see that a 3% increase in inflation translates into almost 7% gain for the portfolio. Again, maybe a little counterintuitive, but an increase in inflation is positive for the returns. And it's almost more than 2 times the inflation rate, the performance. So let me just summarize this page. So the 3 main takeaways. First of all, the main market factors that drive your portfolio are the domestic equities, the dollar exchange rate, and inflation. The second conclusion is that there's little diversification in the portfolio. So you can see it at the chart at the bottom of the page where we show the individual asset class. Sorry, I keep switching it off. We show individual asset classes, how they perform into these 3 scenarios we highlight. You can see that all these bars point in the same direction, with the sole exception of core fixed income, which is somewhat maybe surprisingly, something incidental, but under all 3 scenarios, the core fixed income strategy doesn't deliver any meaningful performance. There's little diversification. So normally you would want for some, especially in the risk-off scenario, you would expect some asset classes to deliver positive performance.
So can you talk about how you would use this? Maybe Steve, how does your investment committee use this information? Because I don't find it very useful at all.
Don, I need use a mic.
Sorry, I think it would inform the asset allocation discussions down there.
But a 12-month horizon predicting, I mean, look at the risk on and risk off numbers for fire. They're almost identical in the I mean, it's a 50-50 proposition.
You just hit on my third conclusion. Thank you. Yes, that's exactly what it is. I completely agree with you. So when you look on the up and down scenarios, the outcome is very similar. And specifically focus on the benchmark versus the portfolio. In the risk on scenario, the portfolio is outperforming the benchmark, which is good. In the risk off environment, the portfolio is again underperforming the benchmark. So what it tells me that we're putting slightly more risk on the portfolio, but there's not what we call convexity. So the expectation is the portfolio performs better on the downside. You cushion on the downside, but you capture more on the upside.
Sorry, if you want the question on the record.
Hello, okay. Hedge funds in particular, shouldn't they be the opposite of what, if our portfolio goes up, they go down, or at least stay even and vice versa? So could you explain, or Doug, I'm not sure who?
That's an excellent question. And there are 2 points to make about the hedge funds. So first of all, not all hedge funds share their positions with us. So we're only getting data and monthly data on about half of the hedge funds. Then some of the positions having challenges modeling, and one of the projects we have internally, the risk team, is to improve the quality of information, the capture of the information. So there's some work to be done around hedge funds. That said, it's a fairly small allocation. Hedge funds, 5.6% of the portfolio. But you're right, that potentially could be one of the areas where which may provide a diversification. I would question it's at 5.6%. It's actually enough to provide a material offset.
Sorry.
I apologize. The 5.6%, I thought we were allocated 4% to hedge funds. So is that a denominator effect because of the way the market has gone? The 5.6 allocation to hedge funds? No? Am I right? Aren't we at 4% for hedge funds?
Probably, yeah.
Yeah, I don't.
Yeah, there's 932 million.
Guys,
Yeah, I'm sorry, I can't do the math in my head. It's with it. I looked at it this morning. There was 923 million in hedge funds versus a 17.293 portfolio, whatever that is. It does seem, I think the denominator impact,
I'm
yes,
just curious.
yeah.
Thank you. But I mean, am I wrong? It should be. My voice usually loud enough. So just for somebody who is not a finance guy, I always thought that hedge funds would be not correlated, would be the opposite. So it's just surprising to me to see that it's the opposite of that at this current time. And I'm just curious if that's a testament to where the markets are right now, or do we need to do something different in hedge funds?
No, but again, I just want to underscore that there's some hedge fund specifically is there. We can do more work, and that's one of the projects, active projects. The other area I want to highlight is the private assets, which again we can make some improvements, and it's an ongoing project. Takes time, unfortunately, but that's the direction we're moving in.
And just to make a point about hedge funds, Liam, Steve went through the performance numbers of the trailing asset class returns. We've gotten over the last 5 years 1% from bonds, and I think it's 5.5 or 6.5 from hedge funds, and they have similar volatility, and they have a lower correlation with interest rates and with the equity markets, and that's why we have them in there. I mean, I think they've done their job, and that's how I kind of look at it. Over a longer term time horizon. I tend to believe looking at these numbers with a 1-year lens is chasing your tail a little bit, but.
Their global macro hedge funds will perform differently in this environment than some of those that are more growth related, long short.
Also, you look at the recent performance on the previous page, you can see that for the last 12 months, hedge funds close to flat. It's minus 1.2% performance. So, and again, it's not a single strategy, as Steve just mentioned. This range of hedge funds for these reasons.
I appreciate it. Thank you.
So there's a lot to unpack here, and I recognize that. So what I would suggest is if there are questions, or if there's a desire to come in for even one day and sit with Ed and the team and kind of go through this from a higher level into a deeper dive with terminology and things like that, we're open to setting that up for you, for other trustees and other systems that are interested. You have the resources in BAM at your disposal, and I encourage you to take advantage of those. And I think it's very important.
I'd only add that, sorry, let me, echoey, God, I'm already loud enough. I would only add that I think one of the topics of the STAR discussion and review is meant to be what kind of risk reporting and analysis is helpful for trustees. I know Ed has been begging for direction and guidance from all of us on what it will be useful in our decision-making process and reporting. And so that is definitely a priority for next year.
I would also say now that Baruch is done, we might have a little time to set those classes up.
Great. We'll continue to have, starting the new year, we'll have Friday discussions at 10 o'clock, which I think are really good. Also, I actually think Ed did a great job because he was kind of focused on those key areas that will impact the portfolio. I think it's actually a really good evaluation, and some of it takes time to unpack. So if you want to go through it in more detail in our offices, Doug, I know you came in for the CLO tutorial, which I thought was great. We can do more of that. We're happy to do that.
Yeah, like say at this point, it's like ancient hieroglyphics.
No, I fully realize it's a lot of numbers and a lot of concepts. I'm keenly aware of that, and the discussion we had internally many times, how to strike the right balance and deliver information is helpful to trustees.
So we also been leveraging, Ed also has got a PhD in organic chemistry, and apparently he's worked in hard physical particles in the past. So we had him explain to us the fusion breakthroughs. If you had a half hour, we could go through that at some point as well. And he does a great job.
Maybe Chris's son would like to come in for that. He might actually understand it. So I believe that's concluded the risk presentation. Before we make a motion to go into executive session, I just want to make a motion to adopt the calendar as it stands today that was provided to you this morning. And I will note that we can discuss the December meeting at a later date, because I recognize that there are 2 meetings in that week. And with the holidays, we usually kind of get forced into that, but we are open to changing the December date at any point. But we wanted to at least get something out there for us to work with. So with that caveat that we will address December, I'd like to make a motion to adopt this particular calendar.
I'll second that.
The only question that I have to look at is the February 22nd meeting, because for most of the people who have children might be away, but other than that, we're good.
We could take your children to work day on February 22nd. Oh, and I believe that that's a regular meeting, so we can discuss changing the regular meeting date at any point.
Bobby, if that's on the record, it's not on the record.
Is it off the record? No, you guys.
All right, so all those in favor of adopting this calendar with the caveats that were mentioned?
Aye.
Aye. Okay, Commissioner, I'm gonna now make a motion to enter into executive session. Is there a second?
Second, Bobby Eustace.
Thank you, Bobby. So now we are in executive session. If the cameras could be turned off, that would be great. I'm sorry, if the recording could be turned off.
During the executive session of the board meeting, we discussed various investment matters. We now need a motion to adjourn this meeting.
So moved, John Dorset.
Second, Liam Guilfoyle.
Thank you all and have a wonderful, wonderful, wonderful Christmas and holiday season.
Same to you.
Thank you,
Thank you.
Commissioner, you too.
Thank you, everybody.
Have a great holiday, everybody.
Thanks, Addie, you too.
Happy holidays, man.